Good morning, everybody. Thank y'all for joining our Beef Brunch webinar series. So we've moved from the monthly series, as most of you know, into a seasonal one. And for this season, we decided to discuss cattle marketing. So for the next 4 weeks, including this week, we'll have different topics. But to kick us off, we have Dr. Kurt Guidry. You can see that he'll be discussing understanding the cattle markets, cycles and trends, and all of those things that go with it. Dr. Guidry wears multiple hats for the Ag Center, and I know I'll probably get them incorrect if I try to list all of them, but today we're capitalizing on the fact that he is an economist for us. We utilize that expertise quite often. Before I turn it over to him, just a few housekeeping things. You're going to be muted, and we're going to keep microphones muted throughout the webinar. If you're joining us through the Teams app or link, there is a Q&A box that you should be able to see at the top, and you can enter your questions into the box at any time during the presentation. If you've called in and are listening to us on your phone, you can text questions to me. My number is 512-818-5476. Again, if you've called in and you'd like to text any question during the webinar, my number is 512-818-5476. In the interest of time, we are going to wait until the end to answer all those questions after Dr. Guidry's finished presenting. So with that, Dr. Guidry, I will go ahead and turn it over to you.
Thank you, Dr. Edwards. It's certainly a pleasure to be with y'all here today. And Dr. Edwards mentioned, I'm just going to talk a little bit about the cattle cycle, which kind of gives us an indication of year-to-year movements in cattle prices, and then talk about some seasonal trends, which give us some indication of within a year, how do we expect prices to move within a given year. And why is this important? And I think it's important that when we're developing a marketing strategy to market our cattle, I think one of the foundational things that we have to do to start is, first of all, we need to know, what our cost of production is, and as the basis for what are we trying to get out of the market in terms of a price, and what do we need to get out of the market in terms of a price. But the second thing is trying to get an indication of where do we think prices are moving, either from year to year or within the year. And that's going to be the foundation in terms of where we think what our marketing strategies are going to be. And that's very difficult to try to figure out where prices are going to move from year to year, and even from month to month for the cattle industry, because there's a multitude of factors that really do impact where prices are going to go, both in the short term and the long term. And you can see there from the screen that these are just some, a list of some of the things that can certainly impact the prices that we see as cow-calf producers, from cattle inventory, input and feed costs, weather conditions, a whole host of things that really can drive prices either momentarily or drive them in a lot more of a long-term aspect. So we're trying to combine and get all that information, and what these cattle cycle, the cycle and the seasonal trends can do is can say, well, if things are relatively normal, we would expect these prices to move or to act in a certain manner, and that's what these cycles and seasonal indexes can help us provide us. Again, it understands how the markets typically move and help us make some basis for our projections. And again, we're going to talk about two major indicators, one being the cattle cycle. We've all heard about the cattle cycle. We'll go into some detail on what that is, why it happens, what some things that can impact it, and then what are some things that we can look for that will give us some indication of when the cycle is moving from an expansion phase, for example, to a contraction phase. And then we'll talk about seasonal trends. Again, these are patterns that we see within the year, but they repeat themselves year after year. In terms of when do we normally see cow prices the highest, or when do we normally see the bottom of the cow market? And we can look at those things, and you can use that information in trying to develop your marketing and management strategies. So cattle cycles, start off with cattle cycles. They've been observed really since the 1800s. And typically these cycles last from about 8 to 14 years, with everybody will say, kind of as a rule of thumb, a cycle will last for about 10 years. Dr. Darrell Peel at Oklahoma State University just recently put out kind of a history of the cattle cycles, and basically based on his information, indicated there was 12 peaks in the cycle and 12 lows or troughs in the 11 troughs in the cycle since that first peak in 1890. And then the average difference, the average time frame between the peaks and the troughs has been about more norms of about 12.8 years. The thing about these cattle cycles are, though, that they're going to be a little bit different from one cycle to the next cycle, because as we'll get into some things, there's some other things that can drive producers' decisions to either expand or liquidate their operations. Typically, we think of three phases: an expansion phase, a contraction phase, and then what they call a turnaround, but it's basically just a time between those two. Expansion phase is going to be typically be characterized by higher calf prices. And the idea behind that is that as calf prices increase and profitability increases, it's going to influence producers to maintain cows, to build their herd so that they can take advantage of those higher calf prices and higher profitability. Then we have a contraction part of it, is where profitability and prices are decreasing to a point where it encourages producers to call harder and to reduce their inventories. Again, when prices are really good and profitable, I think the tendency is producers to be a little bit less hard in terms of how they're going to call their cows. And so rather than calling cows that may be in any other year candidates for being called, they may hold on to those cows a little bit longer because of the profitability of each of those calves that they're producing. Conversely, when we start seeing prices and profitability going down, it encourages producers to call a little bit harder and to reduce those inventories. And so, because of the biological processes in terms of the cattle cycle, obviously, if you make a decision to retain a heifer this year, it's going to be sometimes before the calf that heifer produces actually makes it into the marketing channel. And so because of that lag in terms of making a decision to retain a heifer into your cow herd until that heifer actually produces a calf that's going to be back into the marketing channel, is going to be a 2 to 3 year process. And so it takes a little bit of time for the decisions that producers make to be fully recognized into the market. Again, there's going to be some profitability ups and downs in the cattle industry, again, predominantly driven by supply and demand factors related to producers making decisions to either expand or contract their operations. But then there's always some other things that can pop up from year to year that could either influence the cattle cycle, maybe make it last a little bit longer, or a certain phase lasts a little bit longer or shorter. And then those are things like, if talking about profitability being a big driver, well, obviously calf prices are going to be important to profitability. But the other side of that is that input prices and input costs are also going to be a driver to profitability. So if you look, for example, where we're at now, much higher prices than we've been in the last several years, which may, based on the cattle cycle, suggest that we'll start to see some expansion in cattle numbers. But as y'all, as you all know, yes, while prices have moved up, input prices and input costs have also gone up. So maybe we don't have as big of an increase in profitability as we would suggest, just strictly looking at the increases in calf prices. Obviously, beef demand, there's been some times in the past, certainly in the 70s and 80s, where beef demand fell and fell pretty significantly, and that caused a prolonged time of low profitability and caused a much longer, or excuse me, a much longer contraction period than we would typically expect. So that can come in and do that. Obviously, government policy and changes in policy can also impact profitability. So really, anything that impacts profitability can impact how long these cycles last and how long each phase of the cycle lasts. If you look at this long-term picture of cattle inventory numbers and beef cattle inventory numbers, it really does kind of show you where these cycles, and basically we're seeing as, we get to expansion into a peak, then we start to have liquidation and contraction, and we come back to this trough, and then we start it back again. And it's certainly when you see from the 1930s to the 1970s, particularly that this peak then trough was really very apparent. Again, as we get into some of the later years, again, other factors came in that drove the length of the either expansion or the length of the contraction, and that really gives a little bit different look in terms of how this graph may look as we move further. Then as you get into the 2000s, while we still have some peaks and valleys, those peaks and valleys seem to be much more shallow than what we've had in the past. But again, as we look at these things, and if we can predict where we're at in terms of the peak or where we're at in terms of the valley or the trough, we can give some projections in terms of where do we think prices are going to continue to move up, or they're going to continue to move down, and how long they can, and that can help provide some information in terms of making management decisions in your cow-calf operation. This is just another picture of it, just a little bit different. Currently, our current cattle cycle, based on what most people are saying, started in 2014 and currently through 2023. Obviously, over the last several years, we've had a downturn in terms of cattle inventory numbers. So we're actually in going toward a trough. How long we will continue to see downward numbers of cattle in terms of inventory is still yet to be determined. But we're certainly in the downward cycle of the contraction period, or downward portion of the overall cycle. And again, those historically, that would say as we have lower cattle numbers, prices are going to be higher. We certainly have that to this day, to the point where these higher prices and higher profitability is going to start to influence more retained ownership, or retaining more females, and the build back up of the cow herd, and then ultimately the total cattle inventory numbers. And why is this important? Because you look at cattle inventory numbers and calf prices, and you can see that there's pretty significant inverse relationship there. When cattle numbers are high, we typically have lower calf prices. When cattle numbers are when inventory numbers are low, we typically have much higher calf prices. And so knowing where we're at in that cattle cycle phenomenon gives us some indication in terms of maybe the direction in terms of where prices go. It won't necessarily give us the absolute value of where these prices are going to be, but it will give us some indication in terms of the direction. So knowing a cattle cycle and being able to predict where it turns from contraction or liquidation phase of it to an expansion phase of it gives us an idea in terms of where prices may go in the future. It won't tell us that they're going to be $1.50. It'll just say from where they're at today, we think they're either going to go up or they're going to go down. So kind of looking at where we're at in terms of our current cattle cycle, these are some things that we can look at to try to give us an indication in terms of where we're going to be moving or where the cycle is heading. Either are we going to continue contraction or liquidation and lower numbers in terms of our cattle inventory numbers, or are we starting to begin to, or will we have a turnaround and start building those numbers up again? Obviously calf prices are because how they impact profitability are going to be a critical component of that. As calf prices continue to increase, ultimately we would normally think that ultimately that's going to increase the incentives for producers to start retaining females and building cow herds. You look at inventory growth rate, and so how does inventories change from year to year? As those growth rates start to slow down and get smaller and smaller, that could be an indication of an inflection point going from liquidation to now we're starting to build inventory numbers. And again, each one of those has a little bit different implication in terms of where prices, as we start to build numbers up again, I guess short term, we'll continue to see prices be relatively strong because those heifers being retained are not going into the beef market. But ultimately, as those heifers start over the next 2 or 3 years, we'll start to see that those retained ownership heifers, reduced culls, are going to produce more calves and ultimately increase our inventory numbers, which ultimately, everything else equal, are going to start to reduce prices. So the inflection point where we go from liquidation to an expansion phase doesn't necessarily mean that we're going to see prices fall the next year, but it is an indication that over the next 2 to 3 years, we would expect to see prices to fall as inventory numbers increase. Obviously, cow and heifer slaughter, if we're slaughtering them, we can't build herds, we can't build numbers. And so if that cow and heifer slaughter continues to be large, that's an indication that we're still in a liquidation or contraction phase of the cycle, and that gives us again an indication or implication in terms of our prices. And then we can also look at beef production in terms of where that's moving as relates to the cattle cycle. That doesn't have quite as much benefit looking at those two as maybe it did in the past, and we'll talk about why that is here in the future in a minute. So if you look at cattle prices, again, this is average cattle prices, 400 to 500 pound calves, and you can see here for 2023 we're very, very strong in terms of where we've been in the future. So again, we have high calf prices. When does that start to influence producers to build their cattle herds? And so we'll have to watch and see where those cattle prices go. All indications right now that those prices should still remain relatively strong into 2024 at least. And so we'll see when does that start to make some real indications or some real impacts on producers wanting to retain numbers. You look at feeder steer prices, even though that as a cow-calf producer, we may not be selling that particular product, but certainly feeder steer prices have to remain at certain levels to be able to support those high calf prices. And if you look at feeder cattle prices, those are similar to the calf prices have been relatively strong, and current projections are to be still strong as we move into 2024 for the majority of 2024. Start looking at percent rates of change. Again, you look at, so we are basically in the 4th year of contraction of current cattle cycle. And so, historically, we would say we'd have about 6 years of, on average, the contraction phase. So that would say that we would have another 2 years of reduced cattle numbers. And so, again, with those reduced cattle numbers, we should see some higher prices. which again ultimately leads to the next cycle, which would be the expansion phase of it. But looking historically, we would have at least another 2 years of reductions in cattle inventory numbers. Now, there's a lot of things that could change that, and if you look at just some of the past, we've had here 1, 2, 3, 4, 5, 6, 7, 8 years of contraction. This one's 7 years. So again, anywhere from about 6 to 8 years in terms of contraction has been kind of, with 6 being more of the average, has been kind of the historical average for this. So if we look at where we're at right now, another 2 years would be a projection in terms of a continued contraction of the inventory numbers. And again, if you look at replacement heifers, that certainly continues to kind of show that. We've had a pretty significant reduction in the percent of heifers that are kept as replacement heifers. And a lot of that some of that was a function of the 2022 drought, which was pretty significant and helped increase the amount of liquidation that we did have. So if you look at this percentage change, I think without the drought, we probably don't have as big of a reduction in numbers as that we've had in 2020, that we showed off in 2023, started off the year in 2023 with. But again, those other factors can come in and kind of influence how long and how extreme the either the peak or the trough is for a particular cattle cycle. Looking at the cow and heifer slaughter as well, if you look at the percent of the orange line is just cow slaughter, and the blue line is both cow and heifer slaughter combined. And if you look at that percent of the total cow inventory numbers, you can see here in 2022 that we hit some pretty high marks. Both cow and heifer slaughter. You have to go back into the early 70s where we've had a percent of our total inventory that was slaughtered as high as we had in 2022. And again, that was predominantly a function of drought conditions that we had through a large portion of the major cow-calf states around the country. So I don't expect that this percentage to be quite as high as we move into 2023. But again, I still think we're looking at percentages that have been moving upward, and will probably can still be at relatively high levels for 2023, which again would be supporting a continued year of contraction in 2024. And I said earlier, we can't look at beef production and the cattle cycles as quite and make much references to that as maybe as we did in the past. If you look in the past, where we can see there was much more of a correlation between the cattle cycle and what we saw happening in terms of beef production and terms of total beef production. But really, once you've got past the late 80s into the early 1990s, changes in terms of how in the technology and genetics really changed that picture to some degree. Cattle now, we're feeding them for, first of all, that we're getting them fat and market ready at a much earlier age than we did in the past. Those cattle have heavier carcasses, producing more beef or more pounds of total usable beef per animal than we've had in the past. So we're actually at a situation now that we're expanding beef production with significantly lower numbers than we've had at any point in time in history. And so looking at beef production as maybe an indicator of where we're going to see the cattle cycle move is not maybe as a good a tool as maybe it once was several years ago. And if you look at from 2020 to 2023, when we've had a reduction in total cattle inventory numbers, but yet we've seen an increase in total beef production in the United States. And again, some of that is a function of, one, bigger carcasses, cattle moving in and out of the system quicker than what they've done in the past. And then the other thing is the drought impact there. We're putting in more cattle into the feeding system, with putting in more heifers. We're killing more cows. So total beef production is going to increase when we have when we have a forced liquidation like we'd had with some of the drought situations in the past. And I put this picture here just to show what's happening currently in terms of a drought. If you're from Louisiana, you don't have me to tell you that we've been in drought conditions for most of this year. But if you look at some other areas, you look at Central and South Texas, again, severe droughts there. If you look at some of the Midwest there, we have some areas where we have some drought conditions. Haven't heard of widespread liquidation as we've had in terms of across the U.S. as we did last year. But certainly we've got some liquidations happening here in Louisiana and to some degree in Texas as well. And so what does this do? Again, I think this just fuels fire to the fact that we're probably going to be looking at another contraction year in 2023. When we get to 2024, we're going to have fewer cows, fewer beef cows, and we're going to have fewer total cattle inventories than we had to start the 2023 calendar year. And then I'll just throw in this for retail beef prices. Certainly calf prices are going to be impacted by feeder steer prices and fed cattle prices and by supply and just purely from the numbers or supplies of calves that we have out there. But ultimately, calf prices and fed steer prices can't continue to rise up if we have a downturn or a reduction in a total overall beef demand. But if you look at where we're at in terms of retail beef prices, those continue to be relatively strong or extremely strong, historically high, which would provide some support to continued demand, continued strength in the fed cattle and calf prices. That's one side of it, that yes, prices are really high. The other side of it is, are we still selling as much? And if you look at a retail beef demand index, while 2022 was a little bit down versus 2021, you still look at these last 3 years, even in the face of really high prices, that total beef demand has remained relatively strong. And there's really no indication that we're going to see a significant downturn in overall beef demand or significant downturn in overall beef demand. So again, when you look at beef prices and beef demand, what people are buying in combination, those again provide a pretty strong supportive picture for continued price improvement as we move forward. Again, that picture plus with the expectation of continued contraction and reduction in terms of the cattle numbers, both of those would indicate that we would continue to see prices be very strong for at least 2024 and potentially for more years than that. Now, I say that all with a caveat. Market shocks can always come in. We really couldn't have predicted COVID coming in and really impacting demand, at least for a short period of time. And so all of these things market shocks can come in and kind of derail a cycle or derail price movement for short periods of time. Ultimately, supply and demand dynamics are going to win out. And that's really what the cattle cycle kind of is fundamentally saying, is that supply and demand is going to change over time. And that's really going to dictate the major movements in prices, which I still think is true. But some market shocks can come in, weather events can come in to change that, to keep price, maybe keep the peaks from being as high as maybe they would have been, or maybe keep the troughs from as low as what they would have been. And so it doesn't necessarily change the direction. It may just change the magnitude of the direction. I still think we're going to have cycles with peaks and troughs. Those peaks may not be as high, those troughs may not be as low. And it may take us a little longer to get to the peak, and it may take us a little longer to get to the trough because of other things that impact it, but we're still going to get to a peak and we're still going to get to a trough. And that's I think the usefulness of looking at these cycles. Seasonal trends, moving to seasonal trends. Again, the cycles kind of give us an indication of year-to-year movement, but the seasonal trends kind of give us an indication of within-year movement. And typically we base these off of longer periods of time. So usually a seasonal index is going to be a 5 to 10-year index. So basically what we do there is we look at prices periodically, or weekly prices, for example, throughout the year for calf prices. We look at those for the last 10 years, compute a kind of an overall average of those prices, and then relate each week to that overall average. And what this does is it kind of gives us an indication of winter prices are going to be higher in the year. Typically, winter prices are going to be lower in the year, typically for calf prices, for cull cow prices, for those type of things. It's heavily tied to production and demand cycles. So, why do we see cull cow prices typically lower at the end of the year? Is because that's when most people are gonna cull cows at the end of the year, so they don't have to feed them through the winter. And so, because more people are culling cows at the end of the year, the largest supply of cull cows in the market are going to be at the end of the year. That's going to depress prices. Why do we see an increase in calf prices typically in the spring? Because as we get in and we start greening up in the spring, and people start to assess their forage availability, they'll want to go out and buy calves to put on forage. And so we see a little bit of that's more of a demand side cause, whereas the cull cows in the fall is more of a supply side situation. Also in the spring, we typically have fewer calves that are going to be available for purchase, so that also impacts that. And we can use these seasonal trends to kind of project prices over a period of time. This is a seasonal index for steers, and again, this is about a 10 or 11-year seasonal index. And you can see here the higher prices. When you look from about January through the end of April, beginning of May, that's when we would expect that prices would be on average higher during that time of the year. As we get into May, into the summer months, we would expect prices to be a little bit below average. And then we kind of have a little bit of a rebound in July, late July and early August. And then when most of those spring-born calves are going to come to market, and we have a bigger supply, that's when we get to see prices that are going to be, we projected to be below average. That's kind of a long-term history. This is one, maybe just 2020 to 2022. And you can see, if you look at just a 20 to 2022 picture, quite a different picture. And again, we've been in a kind of a 3-year period where we've seen year-over-year increases in prices. And so maybe this is a little bit more of an abnormal picture to it, but we do see in general kind of the same trends where we have higher prices through the first 3 or 4 months of the year. We get into some of the summer months and we get lower prices there, a little bit of a peak as we get into August and September. And then once we get in September and October, we get a pretty big drawdown in terms of prices. What's different between this one versus what we saw previously is that we don't typically see as big of an increase in those prices as we move toward the end of the year, maybe that we've seen over the last 2 or 3 years. And then you can look at the trends, this actual prices thus far in 2023, and you can see here we're not really following that trend to much degree here. Prices have pretty much been on a constant upward trend for most of this year until we got into some of the more summer months, and then it's kind of just leveled out. It does appear that we're going to be kind of trending to a little bit of a lower period here as supplies become much more available during the fall. Similar picture for heifers. This is almost identical pictures that we've seen for heifers. This is just a picture of looking at different muscle grades and looking at the differences. So not only do we see when prices are going to be higher for a steer throughout the year, but depending on the types of cattle that you have, there can also be some differences there. And this just kind of shows the differences in muscle grades. You can have as much as $25 to $30 a hundredweight difference, depending on if you're selling a medium and large frame 1 and 2 versus a 3. And so that can also have a pretty big impact. If you look at steer and heifer prices, those have averaged about $18 a hundredweight difference for the same weights. And you can see there's been some times where that difference has kind of had a much bigger gap. Currently, we're about $20 a hundredweight different between heifers and steers, which would be pretty close to our long-term average. Again, similar picture with cull cows. Again, higher prices as we get into the spring and summer months. Again, mostly a function of a lack of availability of those cull cows. But then as we get into the fall, we start to see prices start to move down as those supplies become much more abundant. And if you look at 2020 to 2022, the pattern for 20 to 2022 is very similar to what we've seen historically, where we've seen higher prices as we get into the spring and summer months, and then a pretty significant drawdown on what those prices are as we move to the end of the year. So how can we use this? So for example, if you look at cull cow prices, this was at the end of August. Those are about right there, about $93 a hundredweight, and that index price is about at that prime time was about 109, 109%. So we can use that price and that index number to project what the average would be, and then from that average we can project what the prices of cull cows are going to be at the end of the year. And if we go through the mathematics of that, so that $93 right now, based on this index, would result into a price of about $76 a hundredweight as we get into the end of the year, if this index value holds true. So you can use some of these things to kind of predict where prices are going to be as we move into the different parts of the year as well. And if you look at seasonal index for fed steers, again, it has its own pattern. We're higher in the early spring months. As we get beyond the barbecue season, then demand kind of falls a little bit. We see a little bit of a downward trajectory in price, and then as we move towards the holiday season, we start to see more demand and a bigger uptake in price as we move into that latter part of the year. So again, that's just kind of a quick and dirty indication of how cycles work and how seasonal indexes work, and how you can use those to perhaps make some decisions, make some projections for your overall marketing strategies.
Thank you, Dr. Guidry. I think that was perfect. It's exactly what we needed to kick off the rest of our series. So if y'all have questions, his contact information is listed there. You can also send those questions to me and I can forward them as well. So just to touch real quickly, coming up for the rest of the series, so next week on September 12th, Dr. Marcelo Vitovato and I will be discussing weaning methods and preconditioning options. On September 19th, Mr. Tyler Bro will be talking buyer expectations. And on September 26th, Mr. Lee Falk will discuss local market options and adding value to calves. Again, Dr. Guidry, thank you so much for your time this morning. I think that was the best way to kick off this series. Those of y'all listening and watching the recording, if you have any questions, please don't hesitate to get those sent over to us and we'll get some answers for you.
Certainly. Be happy to answer any question I can. Thank you so much for having me.
Thank you.